Good morning, good afternoon, and good evening. Welcome to our 2021 Q4 Global ACS Webcast. I'm Gary Berchowitz, a partner in our global accounting team, and today I'm joined by my fellow partner and director from the global team, Scott Bandura and Katie Woods. And in this webcast, we'll focus on some topical issues. The first one is power purchase agreements. The second one is ESG and climate impacts on the financial statements, focusing specifically on Paris-aligned assumptions, consistency of assumptions used, and an investor focus and emphasis on disclosures and transparency. We'll then again look at ESG, an update, but just focusing this time on the impacts to non-financial reporting. And then we'll look at software as a service or SaaS arrangements, a quick update there, as well as a quick update on a recent IFRIC discussion, a tentative agenda decision on cash received via electronic transfers. So please feel free to use the timestamps in the description below the video if you want to go straight to one of the topics we're going to be discussing today.
Great, thanks. Yeah, we'll move on to talk about power purchase agreements. We're seeing corporate entities across a broad spectrum of industries such as retailers, manufacturers, and oil and gas companies becoming involved in power purchase agreements or PPAs in order to move towards green and renewable purchases of electricity and also earn green attributes such as green certificates. There are two categories of sustainable power purchase agreements: physical agreements that require physical delivery of energy and agreements without physical delivery, sometimes called virtual PPAs, financial PPAs, or contracts for differences. So let's first look at agreements with physical delivery. In many cases, these agreements require more purchases than the power needs of the buyer in order to allow the buyer to meet its sustainable energy commitments. Often the producer is generating the electricity using a wind farm or solar facility where there's variability in the production volume of power. The producer generally wants to sell a percentage of the energy produced. So for example, 50% of the electricity generated from a particular wind farm. For the producer, the financing of such projects is often conditional upon no longer being exposed to the price risk for the energy produced. And physical PPAs can be on-site agreements in which buyers directly purchase sustainable energy at a fixed price from the producer at the point of generation, or they can be off-site agreements to deliver energy produced to the buyer via an existing energy network, so for example, through an energy grid. In both types, the buyer could obtain a sustainable energy certificate which evidences the use of green power. And remember, when the buyer turns on the lights at its location, the electrons are identical, whether they're produced through sustainable production or not. So the objective of the buyer in these arrangements is usually to demonstrate that it somehow contributed to putting sufficient green energy into the marketplace to meet its energy needs, even if it does not directly consume that green energy. In many cases, the agreement will be off-site and the grid operator is put in place because in most markets, it's not possible to be physically connected to a wind farm directly. In some cases, delivery to a buyer's account on a grid may qualify as physical delivery, but this is a complex area and you really need to consider this in the context of the local power market and the related rules and regulations. And entities may also want to consider the IFRIC agenda decision on the meaning of delivery that was released in August 2005 when making this determination. Agreements without physical delivery allow the buyer to buy sustainable energy at the spot price in the local market and to net cash settle the differential between the spot price of sustainable energy on the producer's market and the fixed price in the agreement. The producer will then generally sell the energy it actually produced into its local market at the spot price. The objective of these agreements for the producer is to fix the selling price of all the energy produced, and the objective for the buyer is to fix the purchase price for sustainable energy and to demonstrate that they've consumed green energy by obtaining energy certificates. There are many steps to analyzing these types of agreements. The first step is generally to consider consolidation, for example, if a special purpose entity is involved. And generally, the second step is to consider lease accounting. For lease accounting, the IFRIC recently commented on PPAs in a gross pool electricity market, where they addressed whether in this narrow fact pattern, a cash-settled contract operated through a grid could be considered a lease. And in that fact pattern, they concluded that it wouldn't be a lease. It's important to evaluate whether a contract contains a lease, because if it did, that would subject the contract to the IFRS 16 accounting model. We won't go into detail on these points today in terms of lease accounting or consolidation, but when doing an analysis, just remember to not skip over these steps. So today, what we really want to focus on is the last two steps of the analysis in the decision tree, the own use criteria and for those agreements that don't meet the own use criteria and are therefore recognized as a derivative, the possible election to set up a hedging relationship and avoid some income statement volatility. Only contracts with physical delivery can qualify as own use. In looking at these physical agreements, there are several considerations to think about. Firstly, contracts that are not in excess of the buyer's own needs in the reference market may meet the criteria for the own use exceptions, and therefore could be accounted for as an executory contract in accordance with IS 37. On the other hand, a contract in excess of the buyer's needs would not meet the own use criteria and therefore must be fully recognized as a derivative. In some cases, an entity might enter into an offsetting contract to sell energy at a fixed price in excess of what it actually needs. This sales contract would not make the purchase contract own use, and in fact, entering into such an offsetting contract is an indicator that a contract may not be own use. So both the purchase and sales contracts in these cases could be treated as derivatives. We think in many cases the physical PPA won't meet the criteria for the own use exception and therefore will be accounted for as a derivative contract. Purely financial or virtual PPAs will also be treated as derivatives. There are some additional complexities, though, where there is physical delivery of an energy certificate and financial settlement for power. In such cases, entities may need to consider whether the contract is an own-use contract for the physical delivery of power green energy certificates, with an embedded derivative relating to the power settlements. Certain fair value options in IFRS 9 might also be considered in this scenario. A virtual PPA may be used as a hedge of purchases of electricity. However, the physical purchases of electricity have to be highly probable, and to the extent that the PPA exceeds the entity's needs, it will likely exceed what is highly probable for purchase. Entities can designate a proportion of a derivative when designating it as a hedging instrument. However, portions of a derivative cannot be used. So, for example, an entity could designate 80% as a proportionate amount of the net cash settlements of the derivative. However, in this case, because both the derivative and the purchase of power are subject to variability, for example, based on the wind or solar production levels and based on the entity's own needs, determining the proportion to designate can be tricky. As I mentioned earlier, where there are physical certificates that are being purchased and power is being financially settled, an embedded derivative may be bifurcated. This embedded derivative may then also be designated as a hedging instrument, but this is another complex area that's still being discussed. In addition, where hedge accounting is applied, sources of ineffectiveness can arise due to timing of when purchases are made versus when power is consumed from the grid, and due to basis differences if power is being purchased in a different location. And some of these issues may be significant enough to prevent hedge accounting. For physical PPAs failing own use, an all-in-one hedge is a special type of hedging relationship where the contract is designated effectively as a hedge of itself. Although the contract is treated as a derivative for accounting purposes, it will still result in physical purchases of power, and those physical purchases can be designated as the hedged item, with the failed own use contract as the hedging instrument. However, even though the contract will be an economically perfect hedge, there is still a restriction on the hedged item being highly probable, and this was highlighted by the IFRIC in their March 2019 agenda decision on load following swaps. Accordingly, only the highly probable generation under the contract can form part of the hedged item. Designating such hedges can be complex, and we've really only touched on the surface of this. So if you're thinking of applying hedge accounting to these types of contracts, we encourage you to discuss this with your professional advisors. Okay, well, let's move on to the Paris Agreement. Paris-aligned assumptions are a key focus of stakeholders. In this section, I'll take you briefly through what the Paris Agreement is and what Paris alignment means in this context. The Paris Agreement was signed by 190 countries plus the European Union and has the objective of substantially reducing greenhouse gas emissions and thus the impact of climate change. Many countries that have adopted the Paris Agreement have also submitted their plans to reduce greenhouse gas emissions as part of their related nationally determined contributions, and these nationally determined contributions normally include targets of net zero greenhouse gas emissions by 2050 at the latest, with interim targets for 2025 and 2030. The term Paris-aligned assumptions refers to the use of inputs to estimates that consider the application of the Paris Agreement targets by a company. Increasingly, users of financial statements are challenging companies, their management and their directors, and their auditors regarding whether and how climate change is incorporated into financial statements. Although the Paris Agreement will in some cases have a material impact on financial statements, the answer to the question, are these financial statements Paris aligned, is often more complex than the question implies, and is fundamentally driven by the technical requirements of various accounting standards within IFRS. Educational material was prepared and published by the ISB and contains a non-exhaustive list of examples regarding how climate risk may affect the measurement and disclosure requirements of various standards and the various paragraphs of those standards that might be referenced in determining how to incorporate such risks. The ISB is also considering whether to add a project on climate-related risks to its agenda. The ISB's third agenda consultation raises various areas that might be improved, including considering the threshold for disclosing information uncertainty required by IS1, which deals with presentation of financial statements, broadening requirements for value and use when testing assets for impairment, and developing additional guidance on the accounting for pollutant pricing mechanisms. Improving the standards will require the ISB to add the project to its agenda and go through its normal due process for amending IFRS. That being said, in the meantime, there are still various impacts of the Paris Agreement that need to be considered under existing standards. The Paris Agreement will impact each company differently, and therefore the impact on the accounting and disclosure will vary depending on the individual facts and circumstances. So, for example, the company's plans and the regulations in the relevant countries, or in some cases based on how a market participant would view the impact of the Paris Agreement on the company. Broadly speaking, the implications of the Paris Agreement on an entity could impact the recognition or derecognition of assets and liabilities, as well as the measurement of such assets and liabilities and the presentation and disclosure of those items. However, the impacts will vary depending on the nature of the asset or liability because different accounting standards have different recognition, derecognition, and measurement approaches and different disclosure requirements. Let's consider fair value measurement. Fair value would be based on a hypothetical sale transaction for a particular asset. A simple example would be an investment in shares of a public oil and gas company, accounted for under IFRS 9 at fair value through profit and loss. Fair value of such an investment would generally be determined by reference to the quoted price in an active market, that is a level 1 fair value measurement, and therefore would reflect market participants' assumptions on different risks, including climate risk. Since the quoted price has to be used, no adjustments can be made to further reflect climate risk. However, in situations where quoted prices in an active market are not available, the fair value model will need to reflect assumptions about how a market participant would take into account climate change in a hypothetical exit transaction, where this is significant to the fair value of the item. Entity-specific assumptions that are more conservative or more optimistic than what a market participant would consider should not be used, since this could result in a lower fair value than the value determined by reference to the price that would be obtained in a hypothetical sale transaction. Clearly, this is an area that will involve significant management judgment, and where material, these judgments should be disclosed. Let's consider the impairment of non-financial assets. IAS 36 requires an entity to assess non-financial assets for indicators of impairment. Such indicators may take into account estimates of likely negative impacts of the Paris Agreement on the recoverability of an asset or of a cash-generating unit. Therefore, the Paris Agreement may impact whether and how frequently assets in the scope of IAS 36 are evaluated for impairment. However, the recoverable amount of assets under IAS 36 is determined as the higher of fair value less cost of disposal and value in use. The higher of these amounts is then compared to the carrying amount of the asset, or CGU. As we discussed, fair value measurement is a market-based measurement, not an entity-specific measurement. Accordingly, an entity would be required to estimate what the asset, or CGU, could be sold at in an orderly transaction in its principal market, or in the absence of a principal market, the most advantageous market. A fair value measurement can take into account future improvements in the operation of an asset if this is what it would be assumed by a market participant. So, for example, repurposing a combustion engine plant into an electric vehicle plant could be considered if that would be taken into account by market participants. Value in use, however, contains certain restrictions which do not allow future improvements to an asset to be taken into account until such changes are committed. However, value in use would take into account other estimates about climate change and how these may impact the cash flows relating to an asset or cash-generating unit. Several IFRS standards require best estimates to be incorporated into measurement. For example, IAS 16 requires the best estimate of useful life of an asset to be considered. Where there are multiple potential outcomes for the useful life, it may be that the most probable assumption is used. In other cases, the best estimate may be a probability-weighted average. If significant climate impacts need to be incorporated into these scenarios, an entity might probability weight these impacts to derive the entity's best estimate. So let's consider, for example, an asset that has a 75% chance of being used for its physical life of 40 years and a 25% chance of having a life of 25 years due to potential future changes to laws and regulations that might result from the Paris Agreement. The entity might use 40 years for the useful life of the asset based on its best estimate. On the other hand, if the entity used a probability-weighted outcome, it would use approximately 36 years as the estimated useful life. Where there are outcomes that are significantly different than the best estimate, that is, where there is significant variability in the estimates, entities should consider whether it's more appropriate to use a probability-weighted approach for estimating the useful life, or whether a best estimate where a best estimate approach is used, consider the need for additional disclosure about the risk of changes in that estimate. In addition, entities should ensure that they're reassessing probabilities as new information becomes available, and where there's a significant uncertainty, this may need to be done on a more frequent basis or on a more detailed basis. Entities should carefully evaluate whether disclosure is required under IFRS to enable investors to understand the climate-related assumptions underlying the preparation of the company's financial statements. The starting point should be the disclosure requirement in the standard that specifically applies to the measurement of the asset or liability. Additionally, the general requirements in IS1, which deals with presentation of financial statements, should be considered regarding significant judgments and estimates, including consideration of the sensitivity of estimates made. When evaluating the need for disclosures for Paris-aligned assumptions, companies should consider whether the application of such assumptions to reduce GHG emissions could require significant changes to the company's current plans, require significant cost and time to implement, generate more uncertainties and increase the number of scenarios applied in determining the measurement of an item, and have a significant impact on suppliers' cost or products or operations. So to summarize, it's important that companies understand the expectations of their stakeholders and carefully consider the requirements for measurement and disclosure contained in IFRS. There's no single approach to reflect Paris-aligned assumptions in an entity's financial statements. However, this does not mean that Paris-aligned assumptions should be ignored. It simply means that the use of those assumptions needs to be carefully considered and evaluated for compliance with the relevant IFRS. Entities need to ensure consistency between financial and non-financial reporting on key assumptions where such consistency is necessary for compliance with IFRS. For example, where entities publicly discuss a best estimate about the impact of the Paris Agreement on the entity in a sustainability report, and an IFRS standard requires a best estimate approach to be used in measurement, the company would need to consider the consistency between the estimates used for financial reporting and those disclosed in the sustainability reporting. Where there are comments in the sustainability report that have not been reflected in financial reporting, for example, because the entity is relying on market participants' assumptions which differ from the entity's assumptions, the entity should consider the need for additional commentary on why such items have been reflected on a different basis in financial reporting. Entities should also continue to have an open dialogue with stakeholders, standard setters, and regulators on these financial reporting considerations and the consistency with non-financial reporting. For further information, please see our in-brief on Paris alignment and our in-depth available on Viewpoint. And our in-depth includes various FAQs on Paris Agreement alignment and goes into more detail on the application of various IFRS in light of climate change.
Hello, I'm Katie Woods. I'm one of the directors in our Global Accounting Consulting Services team, and I'm going to cover the world of ESG and non-financial reporting. ESG reporting in general has been fast-moving, and the world of ESG non-financial reporting, that's the narrative that companies give about their environmental, social and governance expectations and perspective, has been extremely fast. So I will take you through the latest announcements from an ESG non-financial reporting perspective. So why now? We're hearing more and more from investors that they're looking for clarity about the initiatives that companies are undertaking to be able to compare across industry and rely on information that they're going to use for making decisions. You can see from the data on the slide that investors who are holding those voting lines are more attentive to the ESG risks and actually that they are inhibited if there are no comparable ESG information. The media's picked up on this as well, and they are providing information that investors are focused on sustainable bonds and sustainable funds. The need for comparable, reliable, non-financial information is clear. So what can companies do to address this? This slide has significantly reduced from last year, as we've seen convergence and key players appearing. Convergence is definitely happening. We've included the players in 3 different categories. Those that cover a breadth of topics, including the IFRSB, I'll cover them in a bit more detail shortly, GRI, and the Value Reporting Foundation. Those that have a single framework, or addressing a measurement protocol or a single standard, and then other enabling initiatives, supporting the non-financial reporting requirements. It's really easy to get lost in the names and acronyms, but there is a clear steer to set some standards and have convergence. So, as I mentioned at the beginning, the world of non-financial reporting has been fast moving. The IFRS Foundation has consulted initially on sustainability reporting in Q4 of 2020. Since then, there have been a number of additional consultations, which led to the creation of the IFRSB, announced in November 2021. So what did the IFRS Foundation actually announce? The announcement came on Finance Day at COP26 and said that the IFRSB, that's the International Sustainability Standard Board, would be established. As part of that structure, a couple of the other bodies from the previous slide, the CDSB and the Value Reporting Foundation, the VRF, will be consolidated into the IFRSB. Note that last year, the Value Reporting Foundation was itself formed as a merger of the IIRC and SASB, 2 other reporting bodies. The announcement was supported by the issue of 2 prototype standards, which are likely to be issued as exposure drafts next year, and I'll cover those in a bit more detail in a moment. The announcement also explained that the IFRSB will have a number of locations, including Frankfurt, Montreal, London, and San Francisco. The names of the chair, vice chair, and the rest of the board have not yet been announced. However, once this announcement has been made, the prototype standards, which were actually drafted by a group called the TRWG, the Transition Reporting Working Group, will be reviewed by the IFRSB and then issued as exposure drafts. The IFRSB objective, which was also shared, addresses a number of the issues that I referred to earlier about the needs of investors. So on the slide here, we've got the IFRSB objective. Remember that these standards will need to be adopted by local law or regulation before they're able to be used. But don't forget, in the meantime, other standards such as TCFD, GRI, and some elements of CSRD issued by FRIC, which actually has a much wider scope than European companies, may need to be reported on at the moment. But for the IFRSB, what do the prototype standards actually say? The General Requirements Prototype Standard is a framework for reporting entities. The IFRSB will be issuing a number of standards, they've said that. However, the General Requirements provides a hierarchy, so if there's not that specific standard to follow, then guidance is available within this General Requirements Standard. One of the headlines in that standard is materiality, and the prototype standard follows an enterprise approach. That's that the sustainability related financial information is material if it influences a user's assessment of the value, timing, and certainty of an entity's future cash flows, and hence the user's assessment of the entity enterprise value. There's also clarification about the reporting boundary, so that is what needs to be reported on. Currently, the prototype states that the boundary should be the same as that of financial statements. You'll see from the slide also reference to governance, strategy, risk management, metrics and targets, which is the structure followed for this and the climate-related standard. So those who are currently reporting under the TCFD framework, I'm sure will be very familiar with this structure. The climate-related prototype standard is the first thematic standard that the IFRSB will issue. That's a standard based on a theme, this one being climate. Again, it's based on the TCFD reporting framework. The climate-related prototype provides guidance on narrative and cross-industry metric disclosure requirements. Standard also applies to climate-related risk disclosures, both for physical and transitional risks, as well as the climate-related opportunities available and considered by the entity. Again, aligned to the requirements of that TCFD framework. In addition to the prototype standards, there are technical protocol supplement, which replicates the majority of the SASB disclosure requirements. So there's a lot that's been announced, but what are the next steps for the IFRSB? Once the chair, vice chair and board have been announced, as I mentioned, it is expected that the exposure drafts will be issued with a tight response period. It's then expected that the final standards will be issued during or late 2022. These standards will really be essential to shaping the future of non-financial reporting. So it is really key that all voices are heard. All are encouraged to respond. So I hope this has been a helpful summary of what's going on in the non-financial reporting sector.
In previous webcasts, specifically June and September of 2021, we've discussed the April 2021 IFRIC agenda decision on configuration and customization costs in a software as a service arrangement. That's a mouthful. We discussed the potential accounting implications of the agenda decisions and that entities should expect that it would take time to gather the information necessary to make the changes to their financial statements if they've been impacted by that agenda decision. Now, the agenda decision was part of the March IFRS Interpretations Committee meeting, and it was ratified by the board at the end of April, as I mentioned. Now, as with all agenda decisions, it is applied retrospectively, but entities would be entitled to a sufficient amount of time to make the change. Any changes to the amounts recognized in the financial statements should be applied retrospectively. Therefore, comparative amounts might also need to be restated, as we've mentioned before. And any material change in the financial statements as a result of entities reconsidering their accounting should be disclosed in a transparent way and clearly comply with IS 8, the standard on changes in policies. So why are we mentioning this again? Well, we suspect that most entities that have a December reporting period would have had enough time to consider all the requirements of the agenda decision and obtain the information necessary to reconsider any previous accounting treatment. Entities affected by this agenda decision should be towards the end of having gathered all the relevant information and should hopefully be in a position to report the impact in their December 2021 year-end or interim financial statements. Now, in the rare case that entities have not yet managed to make the adjustments needed, we think that clear disclosure should be provided to explain the reason why it has not been possible to implement the change for the December 2021 year-end, and provide any information that is available at that time and that might be useful to a user to get a sense of the expected change. So I guess the key takeaway here is that if you are impacted by this agenda decision, time is really running out now to finalize this for your December 2021 reporting period, and hopefully you've already got this one covered. In July of 2021, the IFRS Interpretations Committee received a submission about the recognition of cash received via an electronic transfer system as settlement for a financial asset. In the fact pattern described in the request, all cash transfers made via the system are settled, so in other words, they're deposited in the recipient's bank account 2 working days after they're initiated by the payer. So for example, imagine an entity that has a loan receivable from a customer. At the end of the entity's reporting period, the customer has initiated the cash transfer via an electronic transfer system to settle a loan, but the entity only receives the cash in its bank account 2 days after its reporting period. Now, the request asked the committee whether the entity can recognize the cash or cash equivalent on the date the cash transfer was initiated, so in other words, its reporting period date, rather than on the date that the cash is settled, which would be after its reporting date. Now, there is currently diversity in practice in terms of the date at which the entity receiving the cash recognizes the cash or cash equivalent. Our current PwC guidance says that entities should exercise judgment in determining whether it's appropriate to recognize electronic payments as cash and cash equivalents or as a financial asset. So, where did the committee get to? Well, in September of 2021, the committee issued a tentative agenda decision addressing this issue, and the committee concluded that the entity should de-recognize the receivable or financial asset on the date on which its contractual rights to the cash flows from the receivable expire. And it should recognize the cash received as settlement for that receivable on the same date. So, for example, if the entity's contractual right to receive the cash from the customer expires only when the cash is received, the entity would de-recognize the receivable and recognize cash on the transfer settlement date. In other words, the date that it receives the cash in its bank account, rather than on the date that the payer initiated the electronic payment. In the narrow fact pattern considered, we believe that the analysis and the conclusion by the committee and the tentative agenda decision is actually appropriately considering the requirements of IFRS 9. However, if one considers the potential broader implications of the agenda decision, this might have some pretty substantial impacts on current practice for many IFRS reporters. So, for example, in situations in which the entity sells its goods or services to the customers who pay via an electronic payment system. So, if you think about a regular customer who goes into a retailer and swipes their credit card to buy something, this may have implications on that as well, because the cash actually only gets into the merchant's account a couple days after the transaction. Another one is situations where a creditor is paid via an electronic payment system. So in other words, settlement of liabilities. So the cash goes out your account, but you might not have achieved legal extinguishment of the payable. And I guess a knock-on implication of that does that mean that bank reconciliations, as we currently use them in some cases, are no longer applicable? There might also be system implications if your subledger or system is set up to basically de-recognize the payable on the date that you initiate the payment, rather than when you know when the cash has actually reached the creditor. Now, we've noted these concerns in our response to the tentative agenda decision, for which the comment period closed at the end of November. I guess the reason we wanted to raise this now was that if the committee does go ahead and finalizes the agenda decision as it stands, entities might need to make some significant process and system changes based on the broader implications I just described above. And so we figured it might make sense to flag this for folks now, and we encourage entities to follow the IFRS IC meeting next year in early February, where we expect that this issue will be discussed and potentially finalized. So watch this space. We've covered a lot of ground today, and we hope you found this webcast helpful. I also wanted to highlight where you can go for additional resources. On Viewpoint, you'll find a lot of additional information on the topics we've discussed today, so happy reading if you go there. Thank you very much for listening to us today. And for those of you for which it's applicable, happy upcoming holidays and take care.